All right, so I'm here with David Fauchier, who has joined us to talk about all things crypto. David, thanks for coming on.
Thanks for having me. This should be fun.
Yeah, I'm looking forward to it. Why don't we start and give the audience here a little bit of your background and how you got into the space?
Sure. So I got sent the Bitcoin white paper in 2012 and read it and thought it was super interesting. I'd done a history degree. I did a master's in history and did a lot of economic history kind of during that time. I'm 31 now, so university was sort of, kind of financial literacy coming of age around the GFC and the European debt crisis. I'm based in London. So crypto and Bitcoin really for me kind of fit into that in terms of the history of money, which is something I was kind of studying in college. And from the technical perspective, which was that for me, what the protocol was really doing was kind of providing a solution to the Byzantine generals problem, which was kind of a long established maths problem and computer science problem. And what it allowed you to do was really two things. The first was like, how do you get a bunch of people who don't know or trust each other across the internet to agree on one set of facts? And if you can do that and kind of related to it, how do you have digital scarcity? And these were two kind of problems that the internet had been struggling with for a really long time, decades. This was not a new idea. Actually, if you look at the, HTTP, so this is hypertext transfer protocol, but like if you type in a web page that doesn't exist, you'll get a 505 error. There's actually a spec of all of the different error codes that was written, decades ago when this stuff was created. And they already had like payment accepted, payment failed, payment pending within that spec. And there have always been error codes reserved for that. So it's just a nice kind of indication that like this was not a new idea. But the way in which Bitcoin solved for kind of digital money was new and was interesting. And that's kind of what got me hooked. So there was kind of this dual angle to it. On the one hand, it was this concept of kind of digital gold that was private and that was self-sovereign, like a bearer instrument. And that really fit in with, I think everyone in Europe was pretty shocked by what happened in Cyprus. And I think it was 2013. They sort of skimmed off the top of everyone's bank account in the country, I think over 100K. And they just like lopped 20% off or something like this. And then the other angle to it was, this kind of lets you create two-sided marketplaces, or actually n-sided marketplaces over the internet in which anyone can participate permissionlessly. And that surely unlocks a bunch of different things that you can do with it kind of in the future. And so fast forwarding a little bit from 2012, 13, when I was going down that rabbit hole from a technical perspective, not much happened. You had a kind of bubble and a crash. And at least to me, who wasn't full-time in the space, I was working in fintech. The only stuff you could really see, at least at the surface layer, was like Dogecoin and Litecoin, which really didn't add much. There were experiments with colored coins, but there wasn't that much happening. And then in 2015, 16, this is when Ethereum came out. And for me, that was kind of the coming of age, which was like somebody had taken Bitcoin as a concept from a technical perspective and generalized it, in this case, to computation. And that's when I really started going much deeper in the space and joined full time in 2017. And soon after set up a fund of funds called Cambriel Capital, which invested in, we were really one of the first to focus on market neutral as a kind of strategy bucket within the crypto space. So we didn't do the directional stuff. It was really trading focused. And ran that through to summer of 2020, and then joined Nickel, which is a larger kind of 20-person institutional grade crypto asset manager based in London that have a few different products in the crypto space. And I joined them to run a new fund for them, which is a multi-manager platform.
Awesome. So how do you think about, when you think about crypto market structure and how, finance, and you guys are running a fund. I'd love to talk a little bit about how crypto is different. I mean, maybe we start with, valuation models. If you're running an equity fund, there's some history there. If you're running a crypto fund, how do you think about that?
So like crypto market structure, to my knowledge, is unique in compared to any other market structure today, and also historically. Maybe you know of some analogies or asset classes that when they launched look like crypto looks today, but to my knowledge, this is kind of unique. I get like the first kind of most obvious thing about it is for the majority of crypto assets, at least by market cap, there are no fundamental valuation models that are widely accepted. So we don't have the equivalent of DCF for all equities. And so a lot of these assets are trading on technicals and on narrative. And kind of linked to that is the fact that it's all very new. A lot of it is kind of new technology, experimental technology. Bitcoin's now been around for a decade, live, running without any problems, but it's a very, very kind of simple protocol from a technical perspective. Yep. And we've had lots of experimentation and tinkering with all of the others that are much more sophisticated. And so maybe ex Bitcoin, I'd say the rest of the crypto space is very much in the experimental early stage kind of phase of the tech, and therefore it is more risky. And so you have, like this really interesting space where no fundamentals, it's all very new tech, a lot of risk involved, and therefore just a lot of volatility. Yeah. And this kind of volatility and the newness of it are kind of very obvious. But I think what's interesting is when you really kind of dive deeper, we've moved on a lot at lightning pace from this kind of like spot driven market that we had through to about 2018, which was really like you could buy and sell Bitcoin on a bunch of exchanges against cash. And what the market looks like today is just completely different to that. And it opens up tons of trading opportunities.
So what are some of those differences?
So like we've always had this, trades on technicals and narrative, very new, very volatile, and retail dominated. Until very recently, there was pretty much no institutional involvement in the space. And the institutional involvement that we have had since then has largely been spot and Bitcoin. So this is, your US corporate treasuries buying a ton of physical Bitcoin and storing that. But kind of beyond that, you have hundreds of exchanges around the world, and they are listing the same products on different kind of base pairs. So Bitcoin is traded against the dollar, but also against the euro, the pound, the Polish zloty, the Brazilian real, and dozens of fiat pairs. It's also listed against Ethereum, and it also trades against a bunch of other altcoins. So you've kind of got this many-to-many model, which is kind of interesting. And so kind of at a given point in time, like the price of Bitcoin, the exact price of Bitcoin is actually not a simple thing to calculate or think about in the same way as the price of Apple, which trades on the New York Stock Exchange only and only against dollars. You can snapshot the price very easily. And it's not to say that you don't know whether Bitcoin's worth 50 grand or 60 grand.
Sure.
It's more kind of measured in basis points. But if you're doing a high frequency trading strategy, those basis points are your edge. So you have this kind of really interesting many-to-many model. So if you think of liquidity, it's actually kind of fragmented, not only across literally hundreds of exchanges and trading venues, but it's also fragmented across tons of different pairs, because Bitcoin trades against like 100 different pairs. Ethereum does as well, and Bitcoin trades against Ethereum too. And different exchanges will prioritize different base pairs. And then moving even deeper down that kind of rabbit hole, there's a bunch of different, I know you've done a bunch of work in thinking on Tether, but there's a bunch of different stablecoins in this market. And certain exchanges are pushing certain stablecoins. So you might have an asset that's traded against USDT on one exchange, but against BUSD, which is like Binance's stablecoin on another, or Gemini stablecoin, or whatever it is. So you have tons of kind of different pairs.
Hey, if you like this clip, be sure to like and subscribe for more crypto-related content. Also, be sure to check out the full interview and more only on realvision.com/crypto.